Hello, welcome to today's webinar on the annual allowance. I'm Joshua Croft, Senior Technical Consultant here at AJ Bell. So the annual allowance is a fairly well-covered topic, but there were fairly significant changes made in the recent budget to the annual allowance and the various limits. So I thought it'd be a good opportunity just to go through those changes and how that's going to affect clients funding their pensions going forward. The big change in the budget obviously was the removal of the lifetime allowance for next tax year. So that makes the annual allowance even more important now because it's the main limiting factor now when we are considering funding clients' pensions. We also had the announcement after the budget that the changes to the protection regime as well. So now clients who do hold the lifetime allowance protections are for the first time going to be able to fund their pensions without losing that protection. So again, the annual allowance will be the limiting factor for most clients in that respect. So just to cover off how these allowances are going to work going forward and any potential planning opportunities to fund pensions to the maximum amounts in view of not having a lifetime allowance now going forward. So in terms of what we're going to cover then, so just some background on the annual allowance itself, how it works. We'll then look at the carry forward rules, so the ability to carry forward unused allowance from the past 3 tax years and some of the limiting factors around that as well. And then we'll look at the variations of the annual allowance, so the tapering of the annual allowance and then also the money purchase annual allowance that affects clients who have accessed pension funds. And then we'll also look at what happens when you do exceed your annual allowance, so the annual allowance tax charge that applies, so how we calculate that tax charge and also a couple of options for actually paying that tax charge from pension savings. So the annual allowance itself is a soft limit, so you can exceed your annual allowance. There's no big penalty for exceeding your annual allowance, so it's not like the ISA subscription allowance, which is a hard 20,000. You cannot pay more than that into an ISA. With the annual allowance, you can exceed it. It just becomes less tax effective to do so if you do go over your available annual allowance because the tax charge is applied once you do make that excess payment. In terms of what counts towards the annual allowance, so it's all pension inputs essentially, so member contributions, employer contributions, even third-party contributions. Essentially any new money going into a pension will count towards the member's annual allowance for the tax year. Another key distinction with the annual allowance, it doesn't limit the amount of tax relief that is available to individuals. So tax relief eligibility and the annual allowance are 2 separate limits, but they kind of overlap in a couple of areas. So if someone does have high earnings, they can still get the tax relief at their maximum amount, up to 100% of their relevant earnings, even if they are exceeding their annual allowance. But the annual allowance charge effectively claws back some of that tax relief that has been paid. So the Chancellor did announce that the annual allowance was increasing for this tax year. So from April, it increased to 60,000 from 40,000 the last few years. So quite a significant increase in the available annual allowance now for people going forward. If we just look back though on the kind of the history of the annual allowance and the levels it's been over time, obviously at A-Day in 2006, it was introduced at a level of 215,000. And that increased over time to 255,000 in 2010-11 tax year. But then following that, that's when the first quite severe reductions were introduced. So it went down from 255 to 50 in the 2011-12 tax year. And then it was further reduced in the 2013 finance bill to 40,000. And then we had it at that level for 7 or 8 years. And then with the recent announcement, it's increasing by 20,000 up to 60,000 for this tax year. So fairly significant increase in the budget, but if we do look back to where we were when the annual allowance was introduced initially, we still are quite away from those initial funding levels of over $250,000 at one point. So just to summarise then, so the annual allowance is the maximum amount pension savings an individual can make and still receive the benefit of the tax relief. But the annual allowance doesn't restrict the tax relief that is given. So an individual can still claim their maximum tax relief, but if they are over the annual allowance, they will have to pay some of that back through the annual allowance tax charge. And the tax charge essentially works by adding that excess back onto an individual's taxable income. So it's a charge at their highest marginal rate. So it recoups some of the tax relief given back through the tax system. So if we move on to carry forward then, so since the annual allowance was introduced, you've always been able to carry forward unused allowance from previous tax years. So it can be quite a useful mechanism for financial planning if clients, individuals do want to really maximise pension funding. And it's available to quite a lot of people as well. So there is quite a lot of scope if people haven't made the most of their allowances in the past. There is usually options to actually fund out maximum amounts using the carry forward rules. So with the basics of carry forward, so it's the ability to carry forward unused allowance, and there's another key distinction here. You can't carry forward unused tax relief eligibility. So tax relief is always limited to the individual's relevant earnings in the tax year. So relevant earnings from previous tax years can't be carried forward. It's just purely the unused allowance from previous tax years that can be carried forward. You can go back 3 tax years, so you can have the current tax years and the last 3 tax years as well. And the main condition is that the member must have been a member of a UK registered pension scheme in the year that they're looking to carry forward. So member can have quite a wide meaning there. So you can be a deferred member, so it might be an old occupational scheme that's not being paid into anymore, but you're still classed as a member of that scheme. So you'll be able to use carry forward for the purposes of the annual allowance, even if it was kind of just a scheme that was just left, maybe not looked at for a few years, but just by being a member of that scheme, you will have the carry forward available to use in a new pension scheme if you did want to. And it basically works by using the full current year's allowance first, and then you look back to the oldest year where there's unused allowance available. So you go back to the oldest year first, and then you count forward on the next 2 years. So just as an example of how it works in practice, we've got funding here for the last few tax years for this individual, going back to the 2019-20 tax year. So obviously the annual allowance at that period was 40,000. They've made a contribution in the year of 20,000. So they've got 20,000 unused allowance that can be carried forward. Next year they make a slightly higher contribution of 25,000. So 15 gets carried forward. The following year they max out the in-year annual allowance of 40,000. So there's nothing left from that 21-22 tax year to carry forward. 22-23, they make a contribution of 50,000, so they've exceeded the annual allowance of 40, but because they've got the annual allowance from the 19-20 tax year, some unused allowance, that 10,000 could be carried forward. So this individual wouldn't have exceeded their available allowance for that tax year, so there'll be no tax charge applied to them. They could have actually made an additional 10,000 that tax year as well, so they could have made 60,000 in total if they wanted to. But because they didn't, that 20,000 or the available 10 is then lost because it's past the 3-year period when we look to the current tax year. So 23-24, we now have the annual allowance of 60,000. So this individual still got 15,000 annual allowance to carry forward from the 2021 tax year. So they can make a contribution of up to 75,000 in 23-24 before having any annual allowance tax charge. But just a couple of quick examples just to try and illustrate the correlation between the annual allowance and the limits on the eligibility for tax relief based on earnings. So 2 similar examples, but with different outcomes. So the first one here, Janet, so she's a deferred pension scheme member, so she's got an old scheme that she hasn't paid into, so she would qualify and be eligible to use carry forward based on that. She's had no contributions in the past 5 years, she's been abroad and had no relevant UK earnings, and in the 23-24 tax year, she's now earning 200,000. So the question is, what is her maximum personal contribution? So she has 60,000 available from this tax year, but because she was a deferred member for those past 3 tax years as well, she'll also have the 40,000 for each one of those years that can be carried forward. So she'll be able to make a total gross contribution of 180,000 without having any annual allowance tax charge applied. If we contrast that to John, so again, John's a deferred pension member. He hasn't paid any contributions in the last 5 years. For the last 5 years, he's been earning £35,000 a year, and he's recently inherited £200,000 and wants to make a maximum personal contribution. So again, John is eligible to use carry forward because he was a deferred member, but the limiting factor here is John's relevant UK earnings in the tax year. So he still has the annual allowance available of 180,000, but because his earnings are only 35,000, that's going to be the limiting factor in this case. Because he can't use the earnings from the previous tax years, you're not able to carry those forward. It's purely the annual allowance that is available that can be carried forward. So the annual allowance carry forward is kind of irrelevant for John here because he doesn't have the earnings to support a bigger contribution than the standard allowance. So as I say, there is a lot of scope to use carry forward to max out pension contributions for clients, but it's important to remember that carry forward only does apply to unused allowance, and in-year contributions, the limiting factor in most cases is going to be the earnings. So clients with lower medium earnings aren't perhaps going to be able to make the most of carry forward just because the limiting factor is their eligibility for tax relief, which is 100% of relevant UK earnings in the tax year. So moving on to the tapering of the annual allowance. So fairly controversial subject, quite complex. So the taper was introduced in 2016 with the kind of intention of restricting tax relief that's given to higher income individuals. So it works by reducing the standard annual allowance for £1 for each £2 of income above this adjusted income figure. So as I said, it's controversial since its introduction. Particularly, you'll see lots of press stories around kind of senior doctors and consultants who kind of fall into these income brackets, and specifically for doctors because of how the NHS scheme works. It's not as easy to control pension inputs into DB schemes because of the way that the accruals count for annual allowance purposes. So people on high incomes in DB schemes are potentially going to be caught by the tapering. So it has been adjusted over the years to try and take account for that and move as many people as it can out of the taper. And that was one of the announcements in the budget as well. So the adjusted income figure has now gone up to 260 for this tax year. So the 260 is when you start to do the calculation for the adjustment to the allowance, and the threshold income figure is still at 200,000. So that's when you look at doing the adjusted calculation. So they also increased the minimum annual allowance as well that can be tapered down to. So it went from 4,000, which was quite restrictive. That's gone back up to 10,000 now. So the maximum taper that someone can be limited to is going to be 10,000. So reducing by 50,000 the standard allowance down to 10,000 when the taper does apply. For individuals who've got incomes over 360,000, they will be maximising the taper, so they'll have a tapered annual allowance of 10,000. But for people below that limit, so people on around the kind of 200 to 250, it can get quite complex, and you have to do the calculations to figure out if they are going to be tapered and exactly how much the taper will apply to them. So if we just look back on the figures, how they've changed over the recent years. So when it was introduced, the adjusted income figure was 150,000, threshold 110, and we had the minimum taper of 10,000. To try and alleviate some of those issues, they increased the threshold limits. So it went to 240 for adjusted income and 200 for the threshold. But at the same time, in 2020, they dropped down the taper limit down to 4,000. So again, that caused problems. And in the budget a few months ago, they've announced that the adjusted income is going up to 260, and the maximum taper or the minimum reduced annual allowance will go back up to 10,000 as well. So by increasing those thresholds, they hope that they're going to take out some of those people. Less people will be affected by the taper, but it still does remain quite a complex area. So on those adjusted and threshold levels, so these are specific calculations you need to do to work out if the taper does apply. and they both start with the individual's net income. So this is an income tax amount, and it's essentially all taxable income that the individual is subject to. So you take that net income figure, and then to look at the threshold, you have to add in any salary exchange agreements that were established after July 2015. Essentially, that was set up as an anti-avoidance measure, so people didn't just use salary sacrifice to get under these levels. But then once you've got that figure, you then deduct personal pension contributions, so that then gives you this threshold amount. If that threshold amount is over the 200,000, you then look at the adjusted income figure, which again starts with that net income, but then adds in any employer facilitated contributions as well. And then if that adjusted income figure is over the 260,000, that's when the taper will start to apply. Just coming back to that net income figure, so again, this is something that is defined in the income tax manual, and as I said, it includes pretty much all taxable income an individual will receive, so salary, any employment income, including self-employment and partnerships, also includes pension income as well, so state pension and any personal pension income that is received, so that's different from some of the other pension income calculation figures, so relevant earnings, for example, doesn't include pension income, but this net income figure does. And it also includes, importantly, any investment income as well, so things like interest, dividend income, property rental, things like that as well, all go for this net income figure as well. So it's not just a case of the individual's salary and employment income, you have to look at all taxable income that they do receive. So just to run through an example of how the taper works, so it can seem quite complex, but it's generally relatively straightforward calculation. So the example we've got here, David, he earns 230,000 through his employment, so salary of 230, but he also receives dividend income of 10,000. He makes personal pension contributions of 13,000 and receives an employer contribution of 25,000 per annum as well. So if we were to look at his threshold and his adjusted income, we start with the threshold. So we take the 230 of employment income, add on that dividend income as well to get that net income figure, and then we deduct his personal pension contributions of 13,000, which gives us that threshold figure of 227,000. So that's over the 200,000 threshold limit. So then we look to the adjusted income figure. And again, we take the 230 plus the 10,000, and then we add in the employer funded contributions of 25,000, and that gives us an adjusted income figure of 265,000. So the adjusted income is exceeded. So David's exceeded the adjusted income by 5,000. So he's going to lose £1 of annual allowance for every £2 of adjusted income over the 260. So he's 5,000 over the adjusted income level. So his 60,000 standard annual allowance gets reduced down to 57,500, and any contributions made beyond that level will be subject to an annual allowance tax charge. So it still does remain quite complex, the tapering of the annual allowance, particularly for people who are just kind of in the middle of the different threshold levels, and factoring in that the pension contributions they make in the tax year also have an impact on how the tapering will work as well. So it still remains quite a complex area, but hopefully with the increase to the adjusted income, that will move more people out of being subject to the taper. So if we move on to the money purchase annual allowance, so again, this was introduced around the time of pension freedoms. I think the initial intention was to stop people exploiting the flexibility that was offered through pension freedoms by putting money back into pension schemes. But again, it's fairly controversial because it is very restrictive in terms of making future contributions, and it's also something that can't be undone. So once you've triggered the MPAA, you're then restricted to that lower annual allowance essentially forever. So it's very restrictive, which can be quite unfortunate, particularly if someone's just either accidentally triggered it or just needed to make a one-off payment for a short term. That then restricts their future contributions forever. So again, slightly controversial form of the allowance. So it applies to anyone who has flexibly accessed pensions. They then become subject to the money purchase annual allowance after that trigger point. So it's a restriction on any new pension savings post the trigger point. And again, in the budget, this was increased from the lower 4,000 level up to 10,000 for this tax year. So again, that still gives some scope to make extra contributions, even if they are restricted by the MPAA. Triggering the MPAA also removes the ability to use carry forward. So you can't use carry forward once you've triggered the money purchase annual allowance. So again, that's very restrictive, and again, it can't be undone. So once you have done that, you've lost any potential unused allowance from previous tax years, just because the ability to use carry forward is removed. There's a slight correlation between how it works with defined benefit schemes, so they're not subject to the money purchase annual allowance, so you can still continue to have accruals in DB schemes, but that limit is then reduced down to 50,000 for the alternative annual allowance for DB schemes, with the 10,000 for money purchase DC arrangements on the side. So in terms of what the actual trigger points are for the money purchase annual allowance, so this is just taken from the pensions tax manual. So there's various triggers that will start the money purchase annual allowance coming in, and they're all evolved around taking benefits flexibly from a pension scheme. So probably the primary one that we'll see is payments made from designated flexi access drawdown funds. So if you take income from a flexi access drawdown pot, you then trigger the money purchase annual allowance, and your future contributions are restricted. It's important to note that it is only income taken from flexi access drawdown that is the trigger. So clients might want to take their tax-free cash. So an individual can take their maximum PCLS, designate the remaining funds into a drawdown pot, and providing they don't touch those funds, they won't have triggered the money purchase annual allowance. They can continue to use the standard 60,000 annual allowance. So it's only when income is taken from flexi access drawdown that does trigger it. UFPLS payments are a trigger as well, because obviously you're taking income from the pension as well as the lump sum, so that is a trigger. And probably the other main one we'd see is converting from the old capped drawdown arrangements into flexi access, also is a trigger as well. So any clients who do have the old style capped drawdown arrangements, it's one of the benefits of remaining in capped drawdown, because you're not going to trigger the money purchase annual allowance, so you can continue to fund pensions at the higher levels. So in the year when the money purchase annual allowance is triggered, essentially the year gets split. So you have the standard annual allowance up to the trigger point, and then following the trigger point, you're restricted by the MPAA. Just to put that in some sort of context. So this individual has triggered their money purchase annual allowance in October, and they funded 40,000 pre the trigger point, and then post the trigger, they fund an additional 10,000. So the annual allowance for the whole year is 60,000, but the money purchase annual allowance following the trigger is 10,000. So 50,000 gets measured against the overall annual allowance, and 10,000 gets measured against the money purchase annual allowance. So in this example, neither of the allowances have been exceeded, so there's no additional tax charges to pay for this person. If we look at someone who does exceed though, so again, the same scenario, triggered the MPAA at October, funded 40,000 pre the trigger and 15,000 post the trigger. They've made total contributions of 55. So 55 is measured against the overall annual allowance, and that doesn't exceed that. But the 15,000 is measured against the money purchase annual allowance, which does exceed. So there'd be a charge on the 5,000 excess that had been made post triggering the MPAA. So if we move on to the annual allowance tax charge itself, so this is what happens when you do exceed the annual allowance. You have to calculate what the charge is due, and then there's a couple of options for how you have to pay that as well. So the charge essentially reduces the tax relief that was received on the pension savings above the relevant annual allowance. So it gets added back to the individual's taxable income for the year. So essentially they pay income tax on it at their highest rate, so at their marginal rate, and that claws back the tax relief that they've received on the excess of the LTA. It can be slightly more complicated than it sounds to work out what the charge is, because it gets added on after the income tax or into the income tax calculations. So just a couple of examples here, just to put it into context. So we've got Rebecca here, earns 100,000, makes 30,000 personal pension contribution, and receives an employer contribution of 40,000. So exceeded the standard annual allowance by 10,000 for this tax year. So if we then look at her taxable position, so we have a salary, a personal allowance gets taken out of that. So taxable income for the year is 87,430. And then we then add back in the chargeable amount of the excess of the annual allowance. So the 10,000 goes in at that point. So then the total amount subject to income tax is now £97,430. So looking at the tax bill that they would have to pay at the end of the tax year, so we've got 37,700 in the basic rate band at 20%, so 7,540. Because they've made a relief at source pension contribution in this case, that effectively extends the basic rate band, so it moves that income from the higher rate band into the basic rate band through the tax relief. So another 30k goes into the 20% band, so 6,000 charge on that. And then the remaining of the salary income, but also the chargeable amount of the annual allowance excess gets added in there as well. So 29,730 at 40%, so 11,892 to pay there. So total tax bill for the tax year, 25,432. We compare that to what it would be if they didn't have that taxable chargeable amount in there. So if we remove the 10,000, the total tax payable is 21,432, and the difference between those two figures is 4,000, and that effectively is the annual allowance charge for this individual. So this is a relatively straightforward example because it's a higher rate taxpayer who's exceeded the annual allowance by 10,000. So 40% of the 10,000 is the 4,000. So that's a straightforward one to work out. It can get slightly more complex for people who are just on the various tax bands, so just exceeding a tax band, because the annual allowance charge can fall between the bands as well. So another example here, but this person is using a net pay contribution method, so an occupational scheme where the pension contribution is taken out before it's assessed for income tax. So £70,000 salary, they're subject to the money purchase annual allowance of 10,000, and they pay in a 20,000 net contribution. So how their taxable position looks, so they've got their 70,000 salary, but they're making the 20,000 contribution pre-assessment for income tax, so it comes off at that point. And then we also remove the personal allowance as well. So taxable income for this individual, 37,250, and then we add in the chargeable amount of the excess of the annual allowance. So the 10,000 goes in at that point. So we now have total income, total amount subject to income tax of 47,250. So again, their tax bill is going to look like this. So 37,700 at basic rate band of 20%, so 7,540. And then the remainder gets put into the higher rate bracket. So 9,550 at 40%, works out at 3,820. So a tax bill to pay 11,360, including the annual allowance charge, which has been added in. And again, just compare that to what the tax bill would have been had they not exceeded the annual allowance. So they would have straight just had the basic rate band, 7,450. And if we work out the difference between those two figures there, it's 3,910, which is the annual allowance tax charge. It's not a straightforward calculation in this example because some of the tax charge has been included at basic rate and the balance has been put into the higher rate band there. So 450 has been paid at 20% and the remainder 9,550 is at 40% as well. So that's why it can be quite difficult sometimes to calculate the exact annual allowance charge. So in terms of reporting and paying the charge, so it's done through the self-assessment system. So when individuals are completing self-assessment and they have exceeded their annual allowance, they need to report that to HMRC through self-assessment. There's a specific form, it's one of the extra information forms that is available through the self-assessment system. So it's this pension savings tax charge section, and then the annual allowance element is in this box 10. So any of the excess of the annual allowance is input into that box, and then that will go through to the calculation to work out what the tax charge is going to be payable on the amount in excess of the annual allowance. Sometimes these figures will be using estimates, so it's important you can use estimates on the system, but it's important to disclose that to HMRC that you are using estimated levels, and you can do that in some of the other information boxes as well. Once you do have the accurate figures at the end, you've got up to 12 months after the statutory filing deadline to update and either increase the payment or get a refund if the estimates were slightly over. So it's important that is disclosed if you are using estimates to complete these figures. Self-assessment can be fairly complex. The HMRC do have quite a good help sheet on offer for this particular section of the self-assessment. So it's help sheet 345. So that does include quite a lot of guidance about what to include in each box. So if clients are doing their own self-assessment, then this might be a key one to kind of have available for guidance. But this is probably something, particularly if it is higher income individuals with lots of different elements to their tax return, probably one for an accountant to check through and make sure that they're putting in the correct inputs into the self-assessment. So you can settle the annual allowance charge during the self-assessment period. So you can just pay HMRC directly any charge that is due, along with any of the other tax charges that are due at this point. So you can settle it directly, but there is also the option to pay it through the pension scheme funds as well, through scheme pays. So there's a couple of variations of scheme pays, and they're not always available to all pension scheme members. So the standard scheme pays, or it's sometimes referred to as compulsory scheme pays, can only be applied if these certain conditions are met. So it must be that the standard lifetime allowance has been exceeded within the scheme, so you can't use it to pay for annual allowance excesses in other schemes. It also can't be used if it's the taper annual allowance which has been exceeded, or the money purchase annual allowance. So it's only the standard annual allowance that can be charged, that can be paid. The charge itself must exceed £2,000, so it has to be higher than 2,000 to go through this method. And there's also a specific deadline that the scheme has to be notified if the member is wanting to use them to settle the tax charge for them. So that the deadline is the 31st of July in the year following the tax year when the excess occurred. So for example, if I wanted to settle a tax charge for the 21-22 tax year, I must let the scheme know by 31st of July 2023. If it's after that point, then the scheme doesn't have to pay it, and they can't pay it through this method. But providing all the methods are met, the scheme must pay it, so it's compulsory for the scheme to pay if all these conditions are met, and then the scheme also becomes jointly liable with the member for the tax charge. So there's an incentive for them to pay it as well, because they're jointly liable for that charge, and HMRC could potentially come after them for them if they didn't pay the tax charge within the deadlines. So that's compulsory scheme pay, so only available in certain circumstances, but there's also voluntary scheme pays as well. So voluntary scheme pays can be used for any tax charge. So this is where if someone has exceeded their taper or the money purchase annual allowance, you can use voluntary scheme pays. There's no monetary limit or minimum that needs to be met to use voluntary scheme pay. So in theory, any charge can be paid. The payment should be made by the self-assessment deadline to avoid late penalties, so it should be done in the January following the end of the tax year, so the normal self-assessment deadline. So that's when it should, in theory, be paid, but you can still use voluntary scheme pays for kind of historic annual allowance charges. So if someone hasn't noticed for a couple of years, you can use voluntary scheme pays to settle charges from older tax years. It's just there might be late penalties applied because HMRC can impose interest on any tax charge that wasn't settled within the relevant period. So it can be used to pay older charges, but just be aware there might be potentially a late payment charge applied to it as well. And pension scheme administrators can choose whether or not they will allow voluntary scheme pays to be used. So it's completely up to the pension scheme itself. At AJ Bell, we allow voluntary scheme pays from all our schemes, so we are happy to settle tax charges if they were from other pension schemes or if they were late payments that need to be settled. So there's no issue with that. We're quite happy to help clients where we can. And just on the deadline, one other thing just to be aware of. So if we're using voluntary scheme pays, we want it to be settled with HMRC by the January following the end of the tax year. But just to make everyone aware, pension scheme administrators settle these tax bills via the Accounting for Tax report, the AFT return, which is a quarterly return that scheme administrators send to HMRC, covering 4 quarters within the year, and they're set at specific times. So if a client does want to settle their tax charge, annual allowance tax charge, on time, it's important that they're making sure that it's in the period for the July to September AFT return, which is filed by the 14th of November. So they'll need to settle that. Will make sure the scheme administrator is aware of the charge and has all the relevant information in that July to September period. That will then go to HMRC by the 14th of November, so it's met within that January deadline. If you were to leave it until the next quarter, October to December, you'd miss the January deadline because that report doesn't get filed till mid-February. And just to highlight again, the late payment interest rate is currently published at 6.75% by HMRC, so that may apply if people do miss the deadline. It's unclear whether HMRC apply the late payment to all charges that are due, but just to be aware that it is something they can potentially do, and also highlight that because that isn't an annual allowance charge, that can't be settled by the scheme. So the client, the individual, would have to settle that directly with HMRC because it's not an annual allowance charge, it's a late payment interest charge. Okay, so I think that brings us to the end of the session. So hopefully we found this useful. Just kind of to highlight the kind of the key points. So the annual allowance itself, it does not impact how tax relief is claimed. So higher income individuals can still claim their maximum tax relief. It's just if they do exceed annual allowance that they will have this tax charge, which essentially claws some of it back. Carry forward is very useful, particularly if people are wanting to max out contributions and if they haven't perhaps used allowances in the past few years. But remember, there is that link still to eligibility for tax relief, which is measured or limited to in-year earnings. So that can't be carried forward. So just remember that distinction there. The changes to the tapered annual allowance will hopefully have fewer people impacted by increasing that adjusted figure, but it still does remain complex, particularly for people just within the different thresholds and adjusted figures. Key one with the money purchase annual allowance that it is irreversible, so it's a big decision if someone is looking at flexibly accessing funds and they do want to potentially make contributions in the future. So it should be a key consideration when someone is going into drawdown and taking income. And the annual allowance charge, relatively straightforward to calculate, just depending on the individual's total income for the tax year, and there are options to pay it from the pension scheme rather than settling it directly with HMRC. So thanks for your time today. I hope you found this useful. Do feel free to put any questions you have for us, for the technical team at AJ Bell. We'll happily come back to any points that you want to raise following this. Yeah, so send any questions across. And if you do want to contact us, just let us know, speak to your relevant business development manager. They're always happy to put stuff in front of us as technical if anyone does have any sort of technical complex queries they do want looking at. But thank you very much for your time today.